Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, May 22nd, 2023. It is 10:45 a.m. Eastern Time as I'm starting the video, and this is video number one coming off vacation. Started to work up some charts this morning, screenshotting, going to get those out to you to sort of a follow-up to the kind of brief synopsis I gave you last night regarding the equity markets, crypto, gold, silver, US dollar, natural gas, on Treasury bonds, pretty much the stuff I've been watching lately, or was highlighting and trading before going into vacation. So what I'm going to do is it's probably easier to just follow up. I can go through the charts a lot faster. Here's what we're going to do in this order. We'll talk about the equity markets. I'm going to start very briefly, showing you all the indexes from a longer term perspective, and then move down to the shorter term charts. And I wanted to show you the big market leading stocks. As I mentioned last night, I have quite a few of those at or near very pretty significant resistance. So we'll talk about that and the blow off top, possible blow off top here in play. And then I'll go over those other things I covered briefly last night: crypto, gold, silver, US dollar, natural gas, and treasury bonds. All right, so this is a chart of SPY. We're looking at a monthly time frame. That's typically the longest I go out. A lot on this chart. I'm gonna close out some of these windows here. The things that stand out were the big divergent high, especially here on the RSI. You had big divergence. You had pretty much the same kind of big divergence on all the other bear markets in the past couple decades. You can see here these are measured out. The percentage drops from the high. There was a divergent high, 51% bear market, divergent high, 57% bear market. Even these little corrections was what I call them: 15, 22, 20, 36. That was also a divergent high right there, small one. And ultimately another divergent high right there, and ultimately 36%. For some reason, that divergent high is not picked up on there. That was the COVID divergent high. And like I said, COVID was, might have been considered a black swan event, but technically the markets were already pricing in a bear market or a significant correction, and that's what we got. It was just over before you blinked, you missed it. About a 6-week bear market, a la the Fed, who would not allow it to go down anymore, and DC. So we can't just place the blame on the Fed only. And so they gunned it up, and that's where we're at. So look, from a technical perspective, the RSI divergence has grown even larger. A lot of the trend indicators flipped to bearish. This ROC12, you do get occasional whipsaws. Here, let me make it a little bigger. You can see it in the video. It's a pretty good trend indicator. And bear markets, when you get these big red, what I call hills, those are your bear markets. And sometimes in a bear market, the PPO starts to curl up like it did here. It looked like it was poised to cross over. You had almost a crossover right there. And then you had another leg down the bear market. And usually that last leg down is the most powerful one, or at least, if you're counting Elliott wave, you get a P3, third wave down. So I just want to mention that one is pushing right about flat. Those green bars this month is still in play. And again, you get some whipsaws. So we'll watch that. And bottom line is, if we rally up more from here, as I said before I left town, it just chips away at the bearish case. We're kind of stretching about the upper end of the, where this bear market rally should bounce to if it is still a bear market. But by the bottom line is, by most, not all, and I need to be very clear on that, not all metrics, but most metrics, some of my more reliable ones, we still have it where this is likely just a bear market rally. Only time will tell. Doesn't mean we can't go higher and cross over. I'm going to show you some of the other ones there. One of those being the PPO histogram. That's still red. Your last time you had it red was the 36% drop when COVID hit. Time before that, that fourth quarter drop in 2018, that was 20%. 15% right there. 22% right there. And I'm not missing any. If I am, let me know. I mean, a little whipsaw right there, I should say. But 57%, and before all said and done, 51% back there. So these are the indicators I look at, and sure, we've had a bear market rally, and that's what it's going to do. It's going to bring the histogram up, and then if we're going to continue and have another leg down, this histogram will stay red. So, if you're new to the site, or if I haven't said it in a while, I will continue to reiterate before this bear market even started, and many times since. I've stated repeatedly, I believe it's going to be much, much different than bear markets of any bear markets over the last few decades. These were relatively brief, a couple years, 18 months, two and a half, I think about a year and a half to 18 months. And these were the only real bear markets in the past couple decades. The 2000 dot-com bubble burst down to the 02 lows, and then 2007, October of 2007 to March of 09. And then everything since has been one giant liquidity-induced Super Bowl. And because of largely based on fundamentals, I do have a background in fundamental analysis as well. Largely based on that, I think it's going to be a slow roll. I think we've seen a secular trend shift in interest rates, and we're only in the early stages of that. And it's not, as I've said many times over, extremely far from mere coincidence that we've had really the bull market all the way back in the in the 80s. This one big secular bull. These bear markets I talk about, these are what we call cyclical bull markets within a larger secular bull market. So your cyclical or your smaller ones. And so if that's the case, then I think a lot of folks are looking at the two previous ones, and I don't think those comparisons are going to prove to be accurate. In other words, 18 months to maybe 2.5 years. I think we're looking at a much more of a multi-year bear market. All right. Anywho, so the other things, I'm going to turn off all the lines. I know this chart's a little busy. Squish this down a little bit. Some of my favorite tried and true trend indicators, again, go over these a lot, are these the 20 period exponential moving average and the simple moving average. And this is on a monthly time frame. So these are 20-month moving averages, both exponential and simple, and the blue and the yellow lines. And they've done, literally, if you're going to do one trend indicator, if you're only an investor, you don't want to actively trade. Also what I do on the site besides equities, I think a lot of people put too much stock into no pun intended, into the stock market. And there are many, many other things out there. I seem to get a lot more comments on my equity market analysis, and I get it. Everybody wants to, quote unquote, beat the stock market or trade the stock market. But there are many opportunities out there in other things, commodities and, hard, soft commodities, treasury bonds and crypto and you name it in different sectors. But these trend indicators, as you can see, and again on a monthly chart, you always want to use all that really matters is how you close the month, not intramonth. So when you look closely, ignore the skinny parts. That's what we call the shadows on a candle. That's what happens intramonth. It's you look at the body, and when you get a solid close below, that's what you had there. You've had that signals a trend change, and you're in a bear market. And not only that, get out of your long, start shorting if that's your thing. Rallies back to those moving averages, which you had here, typically provide and cap the bear market rallies, especially after the bear market started. Ultimately you're going to cross back over, and you had both of them taken out there very clearly. And then, they did a nothing short of a phenomenal job of defining the trend. It's really, honestly, that simple. And so there it is. So you broke down, you back tested in 2007, 2008. Hopefully you have a good sized monitor. If you're watching this on your phone, you probably can't see, but I encourage you, put these up on your own, replicate these on your own charts. And, it's not perfect. Sometimes you have a spike below and a monthly close. I'll take that back. That's a green candle. You close right back above it, but the previous month you had a whipsaw. But very, very few. You're looking at dozens, probably hundreds of candlesticks here over the last couple of decades. And it's simple. If you took a whipsaw signal and got out of your longs, you would have just got back in the following month when you had a close, and you would have vastly outperform the market, especially if you're a flexible trader and you didn't just get out of your longs, but you actually shorted and profited from those bear markets. So here we are today. I'm just going to go through all the indexes real quick. The blue is the exponential, the yellow is the simple. I put them up both because sometimes one will do the trick, sometimes the other will do the trick. And that's where we took it out. See, we tested it. That was a monthly, that's a doji. We closed right on it. And then that's a solid red candle. The red candle, my candles are set to show the fat part, the body. If it's red, you look at the bottom of the candle, and that's where we closed. So in the green, we back tested, rejected, back tested, rejected. And it closed all the way down there. Back test, back test, back test, back test, back test. We're back testing the 20 simple right now. Okay, I don't want to beat a dead horse, but nothing has changed from this time frame yet. You don't want to, you don't need to stare at this and say, oh, did that one close above and it didn't? But right now, this is intramonth, so nothing between today, May 22nd, and the end of the month really matters. And, if we were to close right now, we're a hair above it. Yeah, you really want to see a solid close. Now, certainly, the odds start to go down again on the bearish case and up for the bullish case if you can recover it. But again, based on my analysis and the fact that I expect this one to play out a lot different from other bear markets, this is, continue to view this for long-term traders as an objective entry for swing and trend short positions for the next leg down. And as I mentioned before, scale out. And I'll get to that in a second. I actually had two of my lots hit before when I went on vacation, because I told you I really just was checked out. And when I glanced at the phone, the market wasn't doing much other than that, maybe a potential blow off top in the Qs. But I actually went right back in right just before I went home on Friday and added back two of those lots. One of those lots. So I had a little less long exposure than I did when I went on vacation. But may add to it soon here. I'll get to that 1 minute. All right, so that's SPY. Let's just go through the others quickly. Let's look at the equal weighted S&P 500. You can do SPEW depending on your charting platform. Nope, that typo there. SPEW. And you can see also done a really nice job. And I've talked a lot about the equal weighteds lately. On and off over the years, I will talk about them, but only when there's such a stark divergence between the cap weighted, meaning the regular S&P 500, especially the regular NASDAQ 100, and their equal weighted peers. Because normally in a healthy market, they're moving up relatively in lockstep. And so this divergence, and I'm sure if you listen to others, I'm not the only one that's been talking about this for a while now. It is stark. And, somebody mentioned, I just scanned the comments and I haven't had time to reply this morning. Yeah, what if we see the rest of the market start to participate? Great. That is a bullish sign. If you see the majority of sectors, holding up, and you see market internals improve, yes, that would be a healthy sign. But as of now, we haven't seen it. So we'll continue to monitor, and if that happens, great. So you can see all the bear markets as quick as they were, because remember the Fed in recent years, in recent decades, just outright refuses to allow the natural process of the business cycle, booms and busts. They don't allow. They think they figured out the magic bullet and they can just always throw money at the market, print money, and it won't matter. And that worked for a long time until it didn't. And now the old inflation has reared its ugly head. So let's do this a little faster. You can also do RSP. It's the same thing. It's just an ETF to trade the equal weighted. You can see also still below, breakdown, back testing the those key moving averages. You have the NASDAQ 100, QQQ, even QQQ a hair above. But again, QQQ is morphed into, really it's not even, technically it's an index, but it's now become almost just like that ETF they have, FANG, FAMG or whatever, or FANG, that holds those the top weighting. These stocks have grown so large, and I've covered this before. Just the top 6, I believe, make up literally over half the returns to the NASDAQ 100. So it is the farthest thing from a diversified index, and the fact that it's just been those 6 lifting, or mostly, not completely, that's just not a good sign. So you can look at the QQQE, the equal weighted, and you can see, and this is why I have not moved off that primary take that this is just a bear market rally and an objective shorting entry if you're longer term trader. Obviously it's been, the Qs continue to hold up, but you can see we are for now 1, 2, 3, 4 months back testing. We were holding it, support, a few intra-month breaks. That was a red candle where the NASDAQ gave up the ghost, the equal weighted, rejected on the 200 exponential there, rejected, ran up, hit the 200 simple, rejected, and that's what we've been at. So you can't go back as far on these. They just, NDXE is the other one. Let me just type that in, see if it goes back a little farther. QQQE is the ETF. NDXE goes back a little farther, and you can see the same thing. A breakdown. If you look closely, You back tested it. You even popped. That's the thing about these trend indicators, because of the higher beta with the Nasdaq, meaning those stocks in a rally tend to go up more. When the stock market rallies and they tend to fall more, it is not unusual to see the Nasdaq pop above there. Let me zoom in for you. There's the equal weighted, and you can see two candles where it took out. Well, that one closed above both the 200. The 20-month exponentially and simple, but the following month it was just a marginal close, and you probably had the S&P failing there and the other indexes, and then you can see what happened. So just like back then, it was the equal weighted rallied 20%. Sure, many, and I was trading at the time, so I know for a fact many declared the bear market was over. It was a great time to buy, and then came the big hammer, fell down on the market. So I'm going to do a few more, and then we'll move on. All right. So that's the large caps. You can look at the Wilshire 5000, probably the single best index. If you're going to say one index is the stock market, it would be the Wilshire. It has the best representation, diversification among sectors, market caps, everything else. And that one is clearly below. There's where actually that was your closing candle below. And you've been back testing every month since, and we're still below the 20-month moving average. Even the small caps, IWM, clearly below, and you can see you can go back as long as you want on the small caps. Last couple bear markets were right here, and it was trading below, and right here you broke it right there. Back test, just like we are now. Even popped it pretty high intra-month, but failed to close even above it. We actually closed that month right there. That was a big fake out, big washout move, and then the bottom fell out. So that's where we're at. These were the major corrections. They were all double digits, well, over 20%. So on their own right, if you want to call it a bear market, that's what you had there. Fourth quarter of 2018, COVID, and here we are now. Okay, so again, not to beat a dead horse, also other trend indicators such as ROC12, the PPO histogram, a lot of those, again, are still showing. I have to take the evidence and look at, like I said, there are some long-term trend indicator or trend lines that are still intact, and that's one more I wanted to talk about, and then we'll move on. SPY, this trend line right here, this blue one, I'm going to have to turn this off and make it a little clearer. This is probably the best primary uptrend line I can draw. I'm not crazy about it. You don't have a lot of reactions. That was COVID right there, and we snapped back up. You have a couple reactions, and this also shows us breaking down and back testing. But let's go off those other trend indicators, and now let's go ahead and move on. So I'm gonna bring this home a little faster now, so we can cover all that stuff I wanted to cover. Or let's see, maybe we'll truncate it here. I'll look at the clock and decide whether or not to cover those other things in a separate video. But what I wanted to show you, I have this is my, what I call busy board. This is a little bit of a cleaner board. Where do I have board 8? Okay, this is Apple. Apple, an earnings juggernaut. Obviously a lot of stock buybacks. I believe that's what's one of the reasons that has institutions drooling all over these tech stocks. And again, they must believe that the economy, there's three scenarios right now: hard landing, soft landing, and no landing. I assume that they are a lot of if it is institutional buying, I don't know how much of this is Apple buying its own stock back, but tech stocks are cyclical. They go up and down with the economy. And so if you do believe that we're going into no landing, we're not going to see a recession, or it's going to be very mild, maybe that, yeah, sure, tech stocks may do well, but otherwise, every other bear market and recession has seen these stocks drop well into the double digits. So Apple, what I wanted to point out, as I mentioned last night, that was a major reaction high from last year, was at August high, and we're at that right now. It was also this reaction high here, this reaction high, and you had this little move there. And once you pop that level, once you fell down, you back tested it there again. So that is significant price resistance. And the other common theme here right now is this is clearly a divergent high, negative divergence on both the PPO and RSI, just like you had divergence here, 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 and you can see what happened after all those. Oh, and right there as well. So that hasn't changed. I'm been gone for over a week, came back. We still have the divergence on the Nasdaq 100, the S&P 500, all these market leaders that I'm covering here. Let me give you the busy board on Microsoft. I'll give it some points. It's looking strong right now. It's probably been the biggest beneficiary of the AI. I don't know if we'll call it a bubble, whatever you want to call it, and call that what you want. But I think AI is a bit overhyped right now. That's just my personal opinion. We'll see if it's really going to change the world and really change the bottom line of these stocks that much. But what I'm circling are two major reaction highs. This was a consolidation range. You can see my little box there, and that's where we had a consolidation right there. Broke down, back tested it, back tested, and right now, as of today, we're above it. So I'm going to give Microsoft points at this moment in time. It's above it. It still has the same divergences it did before I left town. And so if it's going to reverse, it needs to do so soon. And really to help support the case for another big leg down, you're going to need to see Microsoft join. It's just these guys are so indexed, so tight together. If Microsoft's going to continue to run up here, unlikely. We're very overbought. Negative divergence. Last time we had a big divergent high, well, that was a small divergent high, and you got that drop. You can see my positive, aka bullish divergences right there. Marked all these bear market rallies, 1, 2, 3, clear as day, right? And then the divergent highs here, they all marked significant tops. We're talking double-digit drops after all the divergent highs, double-digit rallies after all those divergent lows. And I'm sorry if that's kind of a lot of lines going on, what I call busy board, but it's just the one I had marked up for you. Alphabet. Massive trading range right here. See that yellow box? I'm using my circle tool, but here I can grab a box tool. Frame. Anyways, this is the massive trading range right there. Popped into it once, twice, a couple times. Finally, we were able to get in that trading range, and we rallied right up to it, and we've overshot it. Again, this seems to me these stocks are extremely overbought. Let's talk about that real quick. RSI is one of the best measures out there to see how overbought a stock is. We're at 80 on the RSI. I have a line right here. I have that line because for years now, that is the extreme. The only other time I've seen Alphabet get there was right here. That's why I had that line, and right here. That is beginning of 2018. I'm going to measure the drop for you there. We say overbought is not a sell signal, but it is an indication of exactly that. The stock is overbought. The stock dropped from that point 17%. In fact, most of that 17% just came in a week or so right there. Right there was the only other time, and I'm going to measure it for you there. Roughly 34%. Okay, so I think, no offense to anybody, but I think anybody buying the fangs right here, a stock like this right now, buying it, if you're in it, fine. Trail up stops, great. Buying it now, I think, is insane. And yeah, it's above the that resistance level. But I'd be surprised if we didn't close back down below it this week, if this wasn't a little fake up. This looks very much like a blow off top in Alphabet right now, or at least a near term. And that's what I said last night. I tried to specify at minimum a near term blow off top. And quite like a near-term blow-off top would mean, it's going to come in and correct now, consolidate, work off the overbought conditions, maybe come backfill this gap. That'd be a minimum target right there. There's a gap right there. Or a blow-off top that has a more significant drop to come. And that's what I favor. I know some of you probably don't want to hear it. I still see another 30% or so downside in the markets as of now. I think we're just pushing, like I said, we're at resistance. You can say what you want about it, and I will give points where points are due above the 200-day moving averages. But that's happened in other bear markets where especially some of these, certain sectors, and often the tech sector will get ahead of those and then fail and drop down below them again. So it would certainly be, if you are longer-term bullish, any correction back to the 200 days would be an objective buy point. But if you take them out solidly, there's the 200, the red line, the exponential, and the blue line's the 200 simple. Then you have an uptrend line off the lows right here. And if and when that goes, that's bearish. Okay, a few more. Amazon. My busy board, let's see what I have there. Again, I'll give points credit where credit's due. There was a downtrend line, not the best to find. 1, 2, really 3 reactions. 3 is the minimum amount of reactions to validate a trend line, in my opinion, because any 2 points can be connected at random. But you also have the 200-day moving averages there. But again, when I go back to the longer term trend indicators, here's a weekly chart. You can look at it like this. You want to draw a trend line from the highs right there, come and capture that second candle. That puts us right now on this downtrend line. So PPO, this is another trend indicator right here, and I'll roll back as far as we want. Typically when the PPO line, the white line, is below the 0 line, the trend is bearish, right? Bullish when it's above, bull, bear trend, big correction. I'm going back, this is 2008, 2009. It doesn't look like much because I'm zooming out, but that bear market wiped out a total of, what is that, 67%. So when you're using log scaling, that doesn't look like no, 62 right now. No, 67, that's where it snapped to, yeah. My crosshairs will snap to the bottom of the candle. So that doesn't look like much, but that's a 67% drop. And so as much as we've already dropped, and we were bullish and long, or I was bullish and long this stock at the lows, also at that low there came those bear market rallies. And, that's at this point in time, what this seems to be is nothing more than a bear market rally, especially when you go to these long-term trend indicators. This is that monthly chart again, and there's my 20-month moving averages. And so is as powerful as this rally is. If you're new to this game, the game of trading, investing, I know there's people who say there's no way this is a bear market. These fangs have gone up, and some of them as much as 50%. That's the way it works is if you drop 50% on a stock, which this one did, it dropped over 50%. That's 56%. You have to then make 100% return. If a stock goes down from 100 to 50, it has to then double in price from 50 to 100. That's 100% return. So don't get caught up in again, I'm trying to show you the forest through the trees here. This is bigger picture. And when this bigger picture starts to change, and that's going to be a big thing for me, these PPO histograms going green down here, the ROC 12, and a lot of these moving averages get taken out. At that point, I'll no longer be trying to position to catch a top of this bear market rally. Okay, a couple more. Let's see. I haven't even pulled in a video. That's one I haven't since I got back looked at. But same story as far as the divergences go, and that's a big part of my trading and investing. The last divergent high was right there. It was a small one, little bearish wedge, and it was good for a drop of about 26, 27%. This is much bigger divergence, and the only other times I have negative divergence is right here at that top, right here. There was a double-digit drop, and right there, double-digit drop as well. So that's it, guys. Again, I know some of you might not want to hear it, and these divergences, we keep going up. And there are times, it's not the most common thing, but there are times where negative divergences get burned through, meaning the PPO, the RSI goes out and takes out those previous highs. But I just wanted to kind of reiterate, no change in my outlook. So let's see. I could go over the rest real quick. We're only at 28 minutes. So here's what I covered last night. That's the equity markets. Again, key takeaway, a lot of fangs at resistance. QQQ. Oh, I talked about the potential blow off top. Let me turn off all the lines here. It smells a lot like a blow off top. When a blow off top doesn't come, right here. It comes after a prolonged or an extended uptrend, and all of a sudden you start going almost parabolic. In other words, this is an uptrend right here, but when the uptrend line starts to steepen, I'm not using a parabola tool. If I had one, it would go like that. And here was a strong advance. In the last couple of days, you shot up really strong, and it was followed by a drop that measured 9%. So that wasn't really a blow off top, but we probably had some sell signals back then. Again, this one with that recent rate of ascent appears to be that. Now, if you want to play it safe, you wait till that whole, probably that big green candle from right there. What was that? Thursday. If that gets taken out, that would probably trigger a lot more selling. I'll have to mark up some trend lines and charts, but I just wanted to talk on that. And then the other things, let's see, last night I talked on crypto. That one, again, way to diversify. For a while there, crypto's kind of been on off with the stock market as far as positive correlations and negative correlations. And we nailed the highs on this one. We shorted, if I'm not mistaken, right even before we broke down or right after. We were either right up here on the highs. So now, as I said, really no change. I gave you 1, 2, 3, 4. Did I only give 4 targets? Yeah, I may add an additional target down here, but I'm maintaining T3 and T4. T3 is down here. T4 is right there. Really no change in the last couple of weeks. We hit, this is a second target zone I gave you right here because these levels are in close proximity. So we hit it. Was that the day I left? Yeah, Friday the 12th. That's I flew out Friday morning. So this is last week. We've hit the bottom of that zone. So as I said, we need to take this out. And we've already had it. We already had a reaction there. We had the first reaction was a bounce, tradable bounce. We went back up to T1. Oh no, T1 was right here. I'm sorry. And that's it. So like I said last night, we need to take a solid break of last Friday's lows. Should do the trick since that was a spike low and get us down to T3 and T4. So as I said last night, I continue to maintain those targets. We had a big divergent high right there, clean sell signal. And yeah, I don't see any reason to close that trade out permanently. And again, how you trade it is up to you. You know, you can typically game the bounces off the at least the initial tag of these target zones. ETHE, it's the big crypto ETF. Oh, it's not an ETF. It's an ETF-like instrument, closed-end fund. T3, again, we shorted it somewhere right in there. T1 was a trend line. We hit it there. T2 was this level right there. We hit that. And T3 we hit. Again, I think it was a day I left. Yep. Flew out early Friday morning. And so that was a full tag of T2. I told you it was a near perfect hit. I think, yeah, you can see the pop-up box. The low was $8 even. And I had the target at 802. So, and we've been consolidating. And it's more of a bounce a reaction in time because we're consolidating sideways. And so all we need to do now is take out the $8 level, and that should open the door to T4 and T5 right there. My next two and current final targets. T5 is the current final target. Oof. Okay, next up, gold, silver, US dollar. That one took a while to roll over, just like the stock market, which hasn't really yet. But the divergences, as I say, often do play out, and these did play out. Okay, so we had the divergent high. We've been building divergent. We had a divergent high there. Correction one. Pushed up, made it ever so slightly marginal new high, which was still a divergent high. And so far, it's been good for a drop in gold of about 5%. Again, that's not much, but I usually tell you to trade silver in the minors because you get more bang for your buck. Silver, 24 was a resistance level I've had here for a while, / target. Pretty good resistance. That's where we failed. We broke the trend line right there, but then put in a very ever so slightly marginal new high and a divergent high at that. And silver was good for a drop of about 10%. So, well, worth it for a swing trader. And I also gave you a target before I left. I said a likely target would be a back test of this downtrend line. There's the divergence. Where we go from here, told you yesterday, probably bounce, but I think more downside. Part of that too. I'm going to get to the euro in a second. But GDX, hopefully some of you were able to sidestep or profit from this short. Same thing, divergent high. I reiterated that there. That was the T4 put on way back here in the beginning of the year. We had T1, T2, T3. Then we shorted it, T1, T2. We covered. We hit a divergent low. We rallied. We were heading to T4, but I called it in early, or personally closed out my longs a little bit early there, but then started shorting up here in these levels, and that was a nice pullback. There's some support there. You can see I have lines here. I don't have a strong opinion. I am longer term bullish on gold and silver. Just right now, I don't have a very strong opinion. So, again, if you were to, profit on any or all of that 13% drop, probably not a bad idea to take some profits and maybe just stand aside right now. Again, I don't have a very strong opinion, but part of that, and a big part of my recent bearish call on gold and silver, was the euro and the US dollar. Just to recap, we had a divergent high here, we had a correction, and then an even bigger divergent high, and this was right before I left. We had just broken down below this wedge, and so we hit the that's where there was a bounce off on gold and silver last week. We hit that 107. These are the targets I gave you before. 107.633. We hit it to the button, and I don't believe I've modified that trend line. Last time that trend line was updated or moved or touched or anything was back in June of 2022. So that was a target, and you can see how perfectly we hit that 1, 2 little bounce. Based on the scope of the wedge and the divergence, I think we're probably going to go lower, and therefore that would bring gold and silver down a little more. So, but right now we just hit support, and again, I don't have a very, very strong opinion in the very near term where gold and silver goes. So I'll keep you updated if anything changes there. Natural gas futures. Well, I give you UNG as well. Just quick updates. I told you last night. This is the targets that I had before I left town. The 60-minute chart I gave you, I said that this in the last update, again week before last, said that was very bullish because you had support there. Support, see these two reaction lows? You broke it. That's what we call bear trap, a false breakdown. Bears will short that break of support. And then when you had a breakout right after that, you recovered at number 1. That's bullish when you come back above this support level. And you also had a nice clean downtrend line. You had huge divergences. Divergences have been building since back here. And it's not like don't work. You got a double-digit rally then, but this was an even bigger divergent low that's been building, building, building. And again, like I said last night, 36% rally off that low. How much more do you want natural gas to go up before a correction? So that's why I told you last night I favored a correction. That was also my final near-term target. I believe I laid out before I left, 27.05. But where I'm going, I'm still longer-term bullish on it. Probably, I would say that's a good level to maybe start scaling back in. Let me actually add a trend line right now. Anywhere from there to down to this trend line. Yeah, so this is a likely pullback zone right here. That should cap a pullback in natural gas. That was a small divergent high. And then when you look at UNG, the ETN, I like to do that for the daily chart as well. Come out here. Let's see if these things are going to load. There it is. That's a massive divergent low. There we are. A big positive divergence, just like this was negative divergence. Highlighted at the time. We shorted that at the time. That's negative divergence. This is positive divergence. And so this says on the daily chart, more likely a trend change, not just the 36 or so % rally that we had. Nothing goes straight up. There's a correction, and there's that uptrend line I just gave you there. So we'll probably continue on up higher, at least $8.91, maybe $10 somewhere. Like I said, I don't even want to lay out targets now. If it's a trend reversal, there's probably quite a bit more upside to go in natural gas. Okay, last but not least, the other thing I mentioned last night was Treasury bonds, TNX. Let's go to the longest term charts. This is the 10-year Treasury bond yield. Remember, the yield and prices of the bonds go inverse to one another. That is the secular downtrend line. This is the peak in interest rates. You have the 30-year, the 10-year, the 5-year, everything peaked back in the early 80s right there. Carter leaving office, Reagan coming in. That was the last true inflationary environment was back then in the 70s leading up to that point in the early 80s. And then we had a secular bear market in interest rates, which was a secular bull market in bonds and in stocks as well, because again, this is an immutable correlation. The fact that when interest rates go down, bonds go up. There's no break in that correlation. Like gold, yeah, it's usually correlated to the dollar. Inversely, but sometimes that can disconnect based on supply and demand factors. But bonds do move in lockstep with the interest rates, the price of bonds, and again, so do stocks. This is a, if economics 101, falling interest rates. And this is why I said earlier in the video, this is not mere coincidence that we had one of the biggest bull markets in history, because we've had one of the largest secular bear markets in interest rates, falling interest rates, which are bullish for equities. The cost of capital is cheaper, and alternatives, in other words, people are going to, nobody wants to take lock into a 30-year treasury bond or a 10-year treasury bond at 1%. When they can get 3% on blue chip stock dividends and other things, or growth potential. And so it's those two things, the lower cost of capital as well as the alternatives, when fixed income is not attractive. But when rates start going back up, and this again is just it's a certainty in the financial markets. It always has been. More and more, you're going to see more and more shift between both individual investors, mom and pops, grandma that back here was buying her 7-8% CDs and treasury bonds. She's going to go back out of those risky stocks where she's been forced into, and junk bonds and things like that, forced to get the higher yield to meet her retirement income needs. And you see the same thing with pension funds and everything else. When you start getting higher and higher on interest rates, money moves out of stocks into those secure investments that are now paying a more attractive yield. And it's not it's the higher you go, the more you're going to see that. So, and also, of course, the higher cost of capital. It's going to put a strain on the economy. And again, I've gone over this many times, and you can agree or disagree, but by every metric and technical analysis, this isn't just a rally. We've taken out all previous reaction highs, and we've taken out very clear downtrend lines. I just flipped to the 30-year bond. So, hard to say how exactly this plays out. But my belief is that this marked the end of that secular bear market in rates, and I think rates will continue higher in the coming years, and that's going to be a way to kind of macro, bigger picture trade your 401k or swing or trend trade if we can kind of keep an eye on rates, because that's what I'm doing here. I'm keeping an eye on rates very closely. And don't worry about what the Fed says. Watch treasury bonds. The Fed does not directly control or set interest rates on treasury bonds or even in the economy as a whole. They do set the federal funds rate, but that's only rate that the banks borrow money from directly from the Fed overnight for overnight purposes. They do not set long-term rates. This is supply and demand, credit in the economy, everything else. So that's it. I'm looking at the 10-year. Where was I here? That's the 30-year right there. 10-year, I just showed you TNX. And this is the uptrend line right here in the 10-year. This is probably, if you're going to watch one bond, government bond, this is the one to watch. And I am keeping an eye on junk bonds and municipal bonds and other things. I'm looking for potential red flags. But here we are. We pulled back to the uptrend line. So if we break out here, and we hold this trend line, we have another leg up in rates. That's going to be bearish for equities. And likewise, if we break down and come back in, and that's a possibility. There's my long-term downtrend line. We could backtest that, and that would be, it should be a net positive for equities. Not necessarily. Why is that? Well, one reason, you might have the stock market taking a hard leg down. Maybe we get that other 20 to 30% drop I'm talking about, and what will happen there is institutions as well as some individual investors will flock to safety, do a flight to safety bid into treasuries. So when a lot of money buying treasury bonds, the price goes up, right? Like anything else, more buying than selling drives the price of a security up. And remember, bonds and rates go inversely. So there's a lot there. There's a lot of moving parts to treasuries, but it is something worth watching. Okay, that's everything I covered last night, but there are the charts. And I had two, I don't know if you heard the little bells go off during the video. I had two price alerts trigger. I just wanted to check those. One is SBUX, nice looking short setup. You had a big divergent high right there, and it's right on the trend line now. It's actually starting to crack. That's why my alert went off, but it's not well below there. I think if the stock market rolls over, this one will go down quite a bit. I'm going to give you one other target if you are interested in this as a trade idea. I would say this one's coming back to at least this $91 level, and that would be from where we're at now. You know, again, you want to see a solid close, or especially a solid move or a daily close down below that trend line. That'd be about a 12% drop, and again, that'd be my minimum target. The other one that just fired off was Applied Materials. It's a big chip equipment maker. And again, this is, like I said, with the NASDAQ 100 and everything else, we had these trading ranges. We did have some bullish breakouts on quite a bit of, especially a lot of tech things lately. And what I'm watching, and I expect, is that they'll fail. So there's a breakout of a very well-defined trading range right there. There's a little blow off the top. We're back testing it now. And this divergence tells me that breakout is very likely to fail. That's big negative divergence. This is one of the big chip equipment makers. So this will, if you see KLAC and AMAT going down, that doesn't bode well for the semiconductors. And then your sell signal is going to come here. There's a trend line I have right there. Especially if we go back down to and break below the bottom of the range, about 109.76. So just watch for that. Okay, let me wrap it up here, get the video out to you guys, and see what else I can dig up for you. This has been Randy Finney with Right Side of the Chart. Have a great day.